Yup. Okay. All right. What's up, man? This is me. I'm back again. Going to go over a play that y'all could have made for this week of July. Okay. This is for gold. This is supply and demand setup. I'm gonna put you guys on. All right. So how do we start off from a hindsight? All right. Well, the weekly chart isn't giving us anything. It's just giving us a bunch of higher highs, higher low, lower low, lower high, lower low. What the fuck? Every time I look, the fucking can is moving. Is it me or is this bitch really moving though? Like, yup, yup. I don't know if it's a motherfucking can moving or I'm fucking tripping. All right, but yeah. Okay, so we're gonna go to the daily. All right, what we have on the daily is higher highs, higher lows. We see that this has broken this wick right here. We have broken this wick in the middle of June, okay? All right, so we're gonna just go along here, speed this up. All right, as you see, we're making a demand here, entering into July, okay? It's the daily candle for June 23rd. All right, boom. We broke another low right here. This was where I was thinking about getting in. I seen that we broke this low on June 24th. All right, so I'm thinking since we broke this low, this right here is a good zone to get in. This is a good this is a good demand zone right here that's formed. Why did this demand zone form? Because it has broke this prior low right here. Why we weren't looking for a demand zone to form right here? Because this big wick right here was stopping the demand zone from up here from getting sufficed. But as you see, there wasn't a lot of pressure in the gold, so we had to go with our recent swing, which was this swing right here, and this demand zone, I mean supply zone, was created while breaking this low, this lower low. Okay, so now that we have our supply zone, we were going to wait until let's go to, instead of doing that, let's go to July 1st. Okay, we're gonna go to July 1st now. Every daily candle starts at 12 a.m. Okay, so if you didn't know that, 12 a.m. Eastern Standard Time is when a daily candle starts, and our supply zone is sitting perfectly above here. Now, were there plays in between here? Yes, it was, but what we like to catch are like 1 to 10, 1 to 15s, and I'm going to show you how you could have caught some in between there. There wouldn't be no 1 to 15s or anything like that. But okay, so we were just waiting for this candle supply to get taken. Okay, so we're gonna go to the next day, July 2nd. Boom. Was it taken? No, it got close on July 2nd. Okay, traveling up. Here, let me make this transparent so you guys won't get confused. Uh, okay, so that is our zone. Can you guys see this? Probably can't see that. But we're gonna put the border up so you guys can see that. Okay. So boom. All right. Now we're waiting for our demand zone to get taken. These are 12 a.m. 12 a.m. Thursday, 12 a.m. Friday, Monday, 12 a.m. Tuesday, 12 a.m. July 1st, 12 a.m. July 2nd, 12 a.m. Okay, so we're moving along here. Gonna go to July 3rd, 12 a.m. Boom! At 12 a.m., our July 3rd candle finally hit. What you probably would have did was set an alert here at the supply zone that would have gave you an alert that said, hey, we're hitting this supply zone. Get ready to look for sales. Okay. So now that we hit the supply zone on the daily, we would go to the 4 hour. All right. We would go to the 4 hour to uh, make our entry better. Okay, so on the 4 hour, what we have here, we have a lot of chop. You wouldn't be looking for this. 4 hour wouldn't give you too much information because there is a lot of chop. That is a key thing when you're dealing with these supply and demand zones. Okay, so we're going to go to the 12 hour. The 12 hour is half of the day. Okay, it's very simple. 6 a.m., 6 a.m., 6 p.m., 6 a.m., 6 p.m., 6 a.m., 6 p.m. Okay, so on the 12 hour, we have a summarized supply zone right here. Okay, that gives us a supply zone inside of our supply zone, gives it like a magnifying view of our supply zone. Okay, so if we go to the 12 a.m., we have a consequent encroachment right here in the middle of this supply zone right here. That's giving you an indication that we might not be trying to go any higher than this right here, so we need to zoom in. Okay, so since our 4 hour wasn't showing us anything, except for it did give us a fair value gap. Okay, now this gap right here is a SIBI, a sell side imbalance, buy side insufficiency. All right, and it's giving us a consequent encroachment. Now, we know that if this level right here gets broken, yo, what the fuck is going on, man? If this level right here gets broken, then we possibly have a what they call that a disrespect disrespect of our zone. Okay, so we didn't have a disrespect of our zone, and what we have here, we go to the 1 hour. The 1 hour is giving us a summary, a very precise summary of our supply zone. Okay, if you look here, the last candle before the zone was created. All right, boom, it's giving us a consequent encroachment. Boom, on that 1 hour is giving us a consequence encroachment, and also it's giving us a signal. What's a signal? This indecision candle right here is a signal. This rejection is a signal. Okay, so it's giving us a signal to get ready for sales. Now this is around 12 a.m. the next day. Okay, so we could have either entered here or we could have waited for our market maker sell model. Okay, our market maker sell model. I know you've probably heard that. How do I unclick this bullshit? You probably heard that, but what is a market maker sell model? Okay, a market maker sell model is when we start getting ready to sell. Okay, so we hit our zone right here. Put this in shade, back again in shade. We hit our zone right here, and it's giving us a market maker sell model. Okay, the sell model is once it does what? Break structure. Okay, structure being broken means wicks. Okay, means the liquidity wicks. This is sauce right here. It means the liquidity wick. So the liquidity wick is here. This is structure right here. This is being broken. Okay, boom. There is liquidity being taken from here. This is the liquidity wick right here. Boom. Okay. Now, once structure is being broken, it's going to snatch liquidity after it does a market structure shift. Okay. So we're going to put this for a market structure shift. Okay. Boom. So we're getting ready. We're on a 15-minute chart. We hit 12 a.m. the next day. We already hit our zone. So we're watching the chart now. We're watching the chart. Okay. Boom. We hit a market structure shift. We generated some liquidity, and boom, here's another market structure shift right here. Why? Because it snatched this liquidity right here. So when it snatched this liquidity right here, we're not so quick to enter. All right. So what we want to look for is a fair value gap being formed, pushing the price down. Okay. So we got our market structure shift. We have some resting liquidity here. Boom, here. And we have some resting liquidity here. Boom. Okay, this is our liquidity. We're waiting for our liquidity to get taken because we have this market structure shift. Okay, so let's go through the 15-minute. Boom. What do we have? Boom, we have liquidity being taken. Okay, so our market maker sell model is what? We have a push to the downside, breaking structure, breaking this market, making a market structure shift. And then we have a push back to the upside, snatching the liquidity. Okay, so when is our liquidity, when is it over? Okay, that's what most people ask. When is the liquidity being taken? When is it over? It's when the liquidity was taken and then there is another fair value gap being formed. Okay, okay, so how do we know this fair value gap is legit? Because we go to the left side and we look at this fair value gap right here, and if this is being respected, then you're on the right side of the track. The consequent encroachment, the middle of this fair value gap, you see as I blended both of these fair value gaps in, they are being respected on this side and the consequent encroachment, okay? In the middle of it, okay? You see no bodies are forming above this, and plus there was a, what? Liquidity sweep right here, okay? All right, so since there was a liquidity sweep, we had a market structure shift to the downside, a reverse liquidity sweep back to the upside, and now we have liquidity that we're going to target here. Okay, have liquidity that we're going to target here. Whoa, what the fuck? I gotta get this together. Okay, target here. Target here. Target here. Okay. Why are we targeting these liquidities and then we don't target this liquidity? Okay, we don't target this liquidity because this already swept this liquidity. All right, so once this already swept this liquidity, this becomes a liquidity sweep in itself. All right, now why it becomes a liquidity sweep in itself? Because it swept these wicks here. All right, it didn't sweep these wicks here, did not sweep these wicks. These wicks here was not swept. Okay, this wick right here is by itself. It didn't sweep this wick. Okay, this wick here is by itself. It didn't come down and sweep this wick. Okay, this wick by itself is left here because this wick did not come down and sweep this wick. Okay, this wick did not come down and sweep this wick. They all start going up. All right, so that means that these wicks are free liquidity. This is liquidity range right here that we're going to target. Okay, so now that we got our targets and also we have our market structure shift and liquidity being swept towards the upside, and then a new what is being formed? A fair value gap is being formed right here. Okay, boom. All right, so now that that's being formed, we would got into our entry. Okay, now if we go to the 15-minute time frame, we make our entry here. We would have entered around, let's say, supply and demand setups usually happen around 6 a.m. and 10 p.m. 6 a.m. and 10 p.m. We'll put this here. 6 a.m. and 10 p.m. Okay? Or 10 a.m. and 6 p.m. It could be either or. 10 a.m. and 6 p.m. Okay. All right. Boom. Okay, stick with me here. 6 a.m. and 10 p.m. Okay? you're going to enter this order around 6 a.m. Okay, it's around 6 a.m. We're going to hop on the charts. If we put our short position in here, which we could, our risk to reward would have been the last liquidity sweep right here. And we would have entered at 6 a.m. We would have targeted all this liquidity down here, okay, down to the bottom. Well, we wouldn't target this one because you see this liquidity right here, it was ran. Okay, so we would target up to where the liquidity wasn't ran, and that's here. Okay, so this is a 1-to-4 risk to reward ratio. All right, so what we want to do is wait. Boom. It's respecting our consequent encroachment. You're getting anxiety right now. If it's feeling like a big anxious move that should happen, you should drop down to your 5-minute chart. Okay, see what the hell is going on. All right, so as you see here, we have our fair value gap. We can summarize this fair value gap down to here, and we're getting a respect and the consequent encroachment of this fair value gap. Okay, we have no more sell side imbalance, buy side insufficiency, fair value gaps above. So that means that we could shorten our risk to reward to the last liquidity is being taken. It's right here. This is good. But see, this is 4173, 4186. That's only a 10 pip stop loss, so that'll be good. We just enter here. When we enter here, put our stop loss right here. Put our take profit right here, and then we would let this ride. Okay, let's see what we get. Bow. Bow. We would have got stopped the fuck out. Why would we would have got stopped the fuck out? It's because we had the market structure shift and we didn't have this liquidity above being taken. Okay, so this is why you have to go down to the fractal market shift. That's why I said on gold it's very easy to understand that the lower time frames is fractal with the higher time frames. If you are on a lower time frame and you are expecting the price to go down, what you will want to have first is a liquidity shift. This liquidity has not been taken. Now that this liquidity has been taken, now we can look for the disrespecting of the fair value gaps. Okay, boom, we had liquidity taken right here. One, liquidity sweep. Boom. Okay, had liquidity swept right there. We have an inverse fair value gap after the liquidity sweep. Okay, and then we have a sell side imbalance, buy side insufficiency being formed right here. And we don't expect this to be disrespected. Okay, so what we could have did was enter at that 6 p.m. It's when it happened, around 7. Then around 10 p.m. is when we could have entered. Okay, that's 9:30, 9:45. 9:50, 10 p.m. That's why I said 6 p.m., 6 a.m., 10 p.m., 10 a.m. 10 p.m. is when we had the final market structure shift after our liquidity has been taken. Okay, market structure shift. Okay, liquidity being swept. market structure shift, liquidity being swept. Market structure shift, liquidity being swept. Let's do this together. Market structure shift, liquidity being swept. We're working from the higher time frame here, okay? Working from the higher time frame here. So you want to have a higher time frame liquidity being swept. This liquidity is being swept. There's a market structure shift. This liquidity is being swept. There's a market structure shift. Market structure shift. Liquidity being swept. This is the correlation in the time. Market structure shift, liquidity being swept. Okay. Market structure shift, liquidity being swept. Okay. So now that we have our final market structure shift, liquidity being swept, we're going to see how our fair value gap is holding up. Okay. Was disrespected here, traded back through. Do we have a bullish fair value gap? Yes, we have one right here. The disrespect is real. Okay. Have our latest market structure shift. It's 10 p.m. We can enter here. All right. Say we entered here. Stop loss goes right above here. Our take profit goes down to here. What we have here, a 1 to 7. Okay, 1 to 7. Almost no drawdown here expected. Okay, have a side sales, a buy side insufficiency right here, so we can shorten our stop loss. It's about right here, and then we're going to let this run. It's around 6 a.m. the next day. Okay, around 10 a.m. All right, 10 p.m. 6 a.m. Boom. As you can see, it hit our take profit right here. Hit our take profit right there. Okay. That take profit was exactly this liquidity right here. But it also, if we had held it, it snatched all this liquidity right here all the way down to there, which was a 128. That would have took exactly a day and 21 hours, okay, to hit our first take profit. That took exactly, we're down here, 1 day and 6 hours, okay. How much amount of drawdown did we have when we entered after the high time frame market structure shift? Liquidity has been swept. Fair value gap has been formed. Market structure shift, liquidity sweep, fair value gap. Entering in at 10 p.m. Could have shortened this like this at the top of that gap. Which would have gave us a, go back to our first targets right here. 1 to 16. Drawdown would have been about 1 pip. 1 pip of drawdown. Okay? You see how precise that can be. Precision is key. They say you can't be precise in the market, but you sure can. Okay? Because once we have this market structure shift, liquidity has been swept. Here, here, and here. Liquidity has been swept. Then the buy side insufficiencies start being disrespected, and the sell side insufficiencies start being respected. From the market structure shift, liquidity sweep, and then we look for the respect of the insufficiencies. Okay, consequent encroachment of the sell side insufficiency. It tapped it, tapped it again, boom, traded right through. This candle right here was a sure sign that this buy side insufficiency is being disrespected and the sell side is being respected. Okay, we could have shortened our stop to the consequent encroachment of the new sell side insufficiency that formed inside of the higher range insufficiency, and that would have gave us a, if we would have entered at that 10 p.m. would have gave us a 1 pip drawdown. Okay, 1 pip drawdown. All right, which would have gave us a 1 to 25. A 1 to 25. Now, you would have start getting worried when they start making higher highs and higher lows. Where did that happen? That happened right here. Okay, it happened right here, but you could have hopped back in at the 50% mark if you didn't want to wait. Okay, so if you just wanted to catch this 1 to 20, could have caught this 1 to 20 because this is where buyers stepped in. Would have took it straight to where buyers stepped in the first time. It would have been a 1 to 20. Okay, 1 to 20. Yeah, it would have been a 1 to 20. As you can see on that 1 to 20, this is where the wicks I told you guys to pay attention to the wicks. Okay, this is a liquidity wick, this is a liquidity wick, this is a liquidity wick. All right, do you see these liquidity wicks being formed? And what are the liquidity wicks doing? They're going down. Okay, what do we have here? We have this start to go up. This is how we know that it's going to reverse. They start to go up. The liquidity wicks aren't as big. They aren't as big. They aren't as big compared to the liquidity wicks that's down here. They aren't as big. And then boom, what do we have? We have the 50% mark getting taken right here. And then what? Price starts to shoot down. How do we know price starts to shoot down? There was a rejection off the 50%. Then you have this big bearish candle right here that pops up. Boom. Okay. Then we have a yep. Okay, so boom, we would just took this to the buyers. Just say we just took this to the buyers, okay? Just say if we just took this to the buyers, that would have been a clean 1 to 20. So $1,000 would have turned to $20,000. Okay, $100 would have turned to $2,000. All right, and you could have caught this move. Okay, this move was on the 4 hour. If you were trading ICC on the 4 hour, you could have caught this move, but this is based off strictly supply and demand. Okay, you would have caught this move if you would have paid attention to this floor on the ICC. And this ceiling on ICC. Boom. Anything that breaks below here, okay, that would have been the order. So if it would have broke below here, it would have took it down to here. Okay. Okay. There we go.